I think we're at sort of a bit of a conundrum here between the stock market and the bond market. Um, Clearly the stock market is telling you that equity investors feel very sanguine about economic prospects, that the earnings that it's seeing, at least in the early releases, are certainly enough to propel a broad majority of stocks higher. And so all that is good news for stocks. We've also seen bonds come off the low yields that we saw about a month and a half ago, but they're not exactly racing higher. And what we're seeing, at least early this week, is stocks moving up and bonds moving up. It's very easy to classify, risk on day, risk off day. I think that's actually a lazy way to look at the markets. The stock market's higher, so therefore people are accepting risk and they'll sell government bonds. What happens when you have days where they both go up? It appears to me that we're back to, and I hate this analogy, but the cleanest dirty shirt in the drawer analogy, and that is money flowing into the U.S. We're seeing the dollar stronger for the most part, and we're seeing bonds moving higher, and we're seeing stocks moving higher. Well, if you're getting both of those moving higher, that means money's flow, at least in the U.S. point of view, that means money's flowing into the U.S. Now that becomes a self-defeating prophecy after a while, because ultimately exporters don't want to see the dollar go too strong. So again, we're sort of dependent upon this Goldilocks mentality, even in the dollar. Not too hot, not too cold. We don't mind a strong dollar, but not too strong because it impacts the profits of exporters. Basically, what we're saying here is there's money flowing in. It's somewhat indiscriminate. It's very tough to say that one should be betting too hard against that trend, particularly the one we're seeing in the stock market. But one does have to wonder what if anything might cause this sort of era of happy feelings to end. These things usually do end at some point, and I don't know that we've seen extremes of sentiment, but I think we're getting there. I think we're sort of getting to the numbers of levels of bullishness that might start to worry someone. But there's no magic number in that. There's no magic number that says, we're too, some RSI number or stochastic number that says, we're too overbought, we have to fall apart. Overbought can last for a long time. Or there's no sentiment number that says, we're at this number, 62% or 55%, depending on what you're looking at. There's no magic number that says, people turn around. The markets managed to shrug off U.S. politics. I still think that's going to be a quagmire, but ultimately it really hasn't had much effect on the market, and so it's really little reason to believe that it will going forward. And so I think right now you're just seeing this general comfort level with U.S. assets. The one thing to keep in mind, of course, is the U.S. If you're a bond investor and you can get a couple of percentage points in the U.S. versus the trillions of euros of face value that trade with a negative yield, all of a sudden the U.S. seems very attractive, and so it's very hard to fight that. But I'm looking for signs of caution, but right now it seems to be all systems go. But boy, when it feels that good, that's usually when I start to get nervous.